be like, okay, instead of like losing a lot, you can just be like, okay, this money is already in, so I'll just like bail out, and then instead of you giving me, you remember surrender value, you get the money, but paid up they just give you now a new sum assured.
Okay.
But now you lose all the other like the life benefits. So in the case of a death, you'll not be paid. The only payout will be now at maturity.
And of course that money, while they sit with it, of course, is not going to earn anything significant.
Exactly. And even if you've lost your job, another thing people could also do, you could ask the insurer to reduce your premium to the minimum
that you at least can afford to. But then so the math for the surrender value is this cash value minus the insurance fees,
whatever it is. They calculate it inside, so they'll just tell you this is the amount of money we'll give you. There's nothing you can do,
and then of course minus the penalties, because they have to penalize you. While we're talking about the surrender value, it's very important to note that this is why people call insurance a fraud.
I know.
You said that
is so painful.
To comment about that, you guys are called fraudsters. So are you a fraudster, Miriam?
If you know, I'm not a fraudster. So this is the thing. The reason why people call insurance people fraudsters is because from the very beginning you didn't even understand what you're getting into. How maybe it could be from the point of the agent who's making it look like it's a savings plan. Just that, because you know how an education policy works or an endowment policy works is not how, say, a money market works. You know, on money market, even after 3 years, I can pull out my money. After 2 years, I can pull out my money anytime. So people are like, I've put in so much money, but I'm not getting back the amount of money I've put in. But that's why I said, number one, always remember insurance is not a charity. It's a business. You are coming into this, just always take this thing extremely seriously. That's why I'm saying read this thing very well from the very beginning. Because you are coming, you're having a contract between you and the insurer. So you have promised the insurer, I will pay this amount for this number of years. So if you bail out, just like any contract, you have to pay. Like let's say me and you, Agatha, we have a contract, and maybe 3 years down the line, you're like, oh my goodness, no, I don't want to do this anymore. So there's a financial implication. So you have to
on
pay
my side,
from your side. So you have to pay me. So it's the same thing with the insurer. It's not that it's a fraud. It's just that you did not understand how insurance works. You can't just pull out. It's not a savings plan. It's not an investment plan. So you cannot. The way it's been structured is that like it's a life insurance. So you cannot just pull out your money whenever.
And so you already explained what paid up option is. So then talk about tax relief, though we already talked about it. Maybe you can mention it a bit.
So tax relief, there's usually a 15% tax relief on now the premium it is that you pay. So what that means is like now in the case now you're, you know, obviously upon paying your taxes, there's an amount of money that is the tax is going to be reduced. So it's usually one of the points why people buy insurance, but it should not be them. It's a good one, but it should not be the main.
It should be the informing.
Exactly. So the tax relief now of the 15% to a maximum of 60,000 a year, which it's nice, by the way. That's why like it's a very good thing to also get life insurance. Because or like it's usually in pure life policies or endowments or education policies. So you get now tax relief of that to a maximum of 60,000 every single year. So the taxes are reduced.
And of course, in this country, we have a very poor relationship with KRA. Therefore, anytime somebody comes and sells you something that will make KRA reduce the obligation you have, you buy it very fast. And then policy loan. What is a policy loan?
So there's some policies where an insurer can allow you to take a loan against your cash value. Against me, usually they cap it to 80% of your cash value. So let's say, for example, you've been contributing this amount of money for a while, and you have a cash value of maybe like around 600,000. So insurer can give you a loan up to 80% of that cash value, which is about 480,000. So what usually happens is, you know, some people are like, oh, I need some liquidity, I need some money. But now some insurers also now you have to pay interest. On that. So it doesn't really necessarily make sense. And then some people are like, maybe I can take out the money and then I disappear. But at the end of the day, they have your 600,000 plus. So either
people do that.
There are people who are like, oh, maybe I should take the 480 and then I just disappear. But I'm like, either way, the insurance company is winning. We've already calculated these things.
I would like you to insist on that because people think that they can play games.
You can't play the insurer. you know, like they hire actuaries, they hire the best people so that they make sure that they make their money.
Yeah.
Because I remember it's a business.
Yes.
More than anything. If you want to have peace, just remember you're getting into a contract with a business, not a charity.
Not a charity.
Yeah, they don't owe you anything other than what is in the contract.
Perfect.
Yeah.
They don't owe you anything other than what it is in the contract.
So
exactly. Even if you feel heartbroken,
you cry.
You've
already signed the document.
And you know that's now the other problem, which I remember, you know, a few weeks ago I had a conversation with a conveyancing lawyer, and she was telling me that one of the issues she has when it comes to buying land in Kenya is that people sign these documents with land selling companies. You already signed a document that has X, that says X and Y.
Yes.
And then when it blows up on you, where you don't get your land, your money was stolen, you come to the conveyancing lawyer. The conveyancing lawyer is like, how do you want me to help you?
Exactly. There's nothing I can do.
There's nothing I can do. So it's the same with Marianne here. If something happens to you and your insurance and you already signed a document, there's very little.
Yeah. It's true, because I think Kenyans just generally don't like going to professionals. So you try to save a few thousands for something that's going to cost you millions.
Yeah.
So just be smart about the decisions, because how to buy insurance is not the easiest thing to buy. People just think, oh, just put money here, then I get this. But as I said, it's so much deeper. So if you don't deal with someone who's a professional, someone who maybe just knows how to sell, you're going to be in so much trouble. Because remember, it's a very important aspect still in your financial plan.
Yeah, because at the end of the day, don't forget that we are saying that we're not saying that don't buy insurance. We are saying insurance is a key aspect of your financial planning. Now, what we're saying that you have to do it right.
Yeah,
you have to do it right. Yeah. What are riders?
So riders are the extra benefits that someone gets. So let's say you get a an education policy that says, okay, we can pay you in the case of a death. So there's other extra, like in the case of a critical illness. So some of them, it's not automatic. You have to add them. So they pay a bit extra in the case of a critical illness, in the case of an accident or an accidental disability. Or some also have last expense. In this case, someone dies, there's an immediate amount that is paid off to the family. There's also one which is called waiver of premium. So in the case now you are contributing and then maybe you get a critical illness. The insurer, you'll stop paying the premium, and then the insurer is the one who's going to take care of it. And then at maturity, your people will still get paid. So there's the waiver of premiums.
That's a very nice way of explaining it. And so, are you expected to pay extra for the riders, or how does it work?
Pay extra for
also,
no, it's not free.
I understand.
There's
no free lunch in finance. There's no free lunch in finance.
It's an extra benefit, so you have to pay.
You have to pay. If you need something customized for you,
exactly,
you have to pay.
Yes.
Now let's talk. We are in the juicy part of this conversation, the numbers. And we are going to do this based on a question I get a lot. Are education insurance policies worth it? Are education insurance policies worth it? Now, so I do financial coaching on a daily basis. So once in a while, I will get clients who have education insurance policies, and they will ask me, so Agatha, this is the amount of money I've been paying for this education insurance policy. I would like you to help me understand whether nimekuwa nikitupa pesa ama I made the right decision. So we are going to actually use a practical example of a financial coaching client of mine. So the background is that she's married, she has one child. She took an insurance policy for her, an education insurance policy, very important.
Yes,
an education, not insurance, an education insurance policy for her child. And the premiums, or the amount of money she would contribute per month, is 24,213. And so in total, in a year, she would contribute 290,556. And then for a term of 15 years. So she signed up for a term of 15 years, and the sum assured that she would be paid, and Marianne will explain that in details in a few, was 3 million shillings. But before I give Marianne an opportunity to talk, I would like to note that this client of mine was paying this 24,000 a month, 24,000 and something per month, and she's married, and the husband also had an education insurance policy. So remember what I said, it doesn't end wrong, it starts wrong. Because of course one of the key important things that this couple would have done is sit down and do what Marianne said. Start with the goal in mind. So for this child, when do we want to educate her, and where do we want to educate her? What kind of quality of life do we want? Instead, the wife or my client went to work, an agent came and did their perfect job and sold for her an insurance education policy. And then the husband went to work, an agent came to the office and sold them to, they always come to the office, but they're very good.
Yes,
let's give their credit rights due. They're very good at their job.
Yes.
So the husband went to work and an agent came and sold to them another insurance policy.
Yeah.
So in total, this couple was literally contributing around 50,000 for one child.
Wow.
Per month for one child.
I'm sure the payout was not even all that.
Of course, and now that we are about to get into the details.
Yes.
So maybe Marianne, so maybe I can push it further and say that in terms of their sum assured, the benefits they were getting was if natural death happened, the word natural is very important.
Yes.
They would be paid only 3 million shillings. If it was an accidental death, they would be paid 6 million shillings. And if a critical illness happened, they would be paid 1.5 million. If you and I are familiar with the health system in this country, 1.5 million shillings is a joke, a total joke. And so now the juicy part of this policy was that she was told, you sign up for 15 years and in year 11 we will give you a payout of 750 for year 11 up to year 15. We will give you a payout of a 25% payout of the sum assured. Every year 750,000 and now plus the sum assured, you get a whopping 6 million. Just this is where we have drum roll.
Yes.
6 million. Just give us 24,000 per month and we'll give you 6 million. Marianne, what is wrong with this?
Okay, so now let's just go through the numbers. Even this one, your client is even better than some I've seen, by the way.
You've seen worse.
Hey, I've seen worse. So what usually happens, because people are planning for the education of their kids, they're like, okay, I want maybe like 5 payouts. Because I'm like, okay, year 1 of university, year 2 of university, year 3 of university. So they want, that's how they usually spread it out. That's why you can see here there's the 750, 750, 750, because that's how they want it structured. Because the one thing which is also people like about education policies that you can structure it in that sort of way. But then now, so even, okay, so here we see like from year 11, so year 11 to year 14, there's the 750,000, which accumulatively comes to 3 million, plus now the 15th year, there's the 3 million. So the total that she's going to get is just now what was written, which is the 6 million shillings. But what she has contributed in this span of time is 4.3 million. So what the interest she's made over those 15 years is 1.6 million.
Only?
1.6 million. And then, you know, like as you said, there's usually the tax relief. Now, if we to plug it in, let's just say the overall total benefit is now the 2.29 million that is now here, like what has been indicated. So now when it comes to these things, you see now the thing is that I told you people get excited in now like these different structures. But when you look at it at the end of the day, the return on investment is pretty low. Actually, it's pretty low compared to maybe if you were to use an alternative vehicle. But as I said, to give credit where it's worth, there was now the protection aspect. But again, also the protection was quite low. As you said, the 3 million, in the case something was to happen, how long can it actually take the family?
That is such a small amount of money.
Exactly.
So, of course, one of the key goals of this conversation is to talk about, now that we are saying that the returns from and education insurance policies are low, so then what are you supposed to do? It's very important for us to answer that question. So we also used the same figures, the 24,213 every month for a period of 15 years, and we asked this client, what would have happened if you put this money in a money market fund, for example? And of course, it's very important, and Marianne will tell you that we used a money market fund because it's one of the most conservative investments in this country. So if we did another investment,
it could even be much higher.
It could even be much. So Marianne, maybe you could take us through that.
So now, what usually happens is we like to compare it with like a common money market. This is now if someone just wanted to look at it from an investment perspective. I'm just looking at the return, because there are people who just get it and they're like, me, I just want the return. I didn't really look into the protection. Since now they are like, oh, you know, just put your money here. So now if you were to put the exact same 24,213 into a money market, the return would have been 8.123 million. Which is a big difference from the 6. That's a whole 2 million shilling difference.
You're living on the table.
So the return, you're still contributing the 4.3 million. So the net that you're making is 3.7 compared to the other one where the net was about 1.6 million. So those are the things to also put into consideration. If you're looking at this as growing your money, endowment products do not grow your money. So if you're looking at it just without now like the protection aspect, you're just like, oh, me, I just want to grow my money. Because most of the time when people are done with university and in their first jobs, an agent comes in like, just put your money here.
It happened to me.
Yeah, you see? Yeah. And then now you just continue putting your money here. But now if you look at the larger scheme of things and you look at if it's to contribute this money in an alternative instrument, you'll make so much more money.
And one other thing I've noted from what you're saying is that please think long term.
Yeah.
Please think long term.
Exactly.
Because an insurance agent will come to your office or to your home or wherever, and they will tell you it's just 2,000 shillings.
Yeah.
So it's true, in a short period of time, it's just 2,000 shillings. But how about we project this thing 15 years from now?
Exactly.
It's not just 2,000 shillings. And also, when now we talk about financial planning and investments, that is, when you look at it like that, that's what we always talk about when we say let your money work for you.
Yes.
That money is not just 2,000 shillings.
Yes.
It's money that can literally supposed to work for you.
Yeah. You have to respect your money. It doesn't matter which amount of money.
It doesn't matter if you're contributing 1,000. Yeah.
Respect your money.
And again, that's why that's why now I insist. That's why you need financial coaching.
I know. That is true.
That is why professionals exist, right?
Pay professionals, please. It will save you heartache. I want to say it will heartache your money, your time.
Yeah. And so honestly, basically what we are saying is that this person would have made much more. We computed and we realized that they would have made much more, and we will display on the screen all these figures as we are talking about it. Now, another important thing to talk about is when people approach me and they tell me, Agatha, yes, I know I could put money in a money market fund. I'm very happy that when we are talking about the money market fund, you said this is important for people who are thinking of it as an investment.
Yes.
Very important to differentiate the two. The people who approach us and they are looking, they want their mindset is as it an investment. Now we have another bunch of people who will, when I tell them about a money market fund for planning for the education of their kids, they will tell me, but the money market fund doesn't come with the insurance benefits. So why would I sign up for a money market fund? What's your response to that?
Okay, so as I had mentioned earlier, let me talk about myself and then we can go back into the numbers.
Yes.
I have two children, one who's 2 years and 3 years old.
Yeah.
So when I looked at the education plans, because trust me, I've gone through so many in this country. So I was like, to me, this is not making sense. Especially from a return perspective. But then also I have to make sure that my kids are protected, no matter, because I'm a single parent. So I need to make sure that my children's monies are protected because I'm the sole provider. So I put my money in. I've separated. I have an education plan for my kids, which has both the protection element and the investment element. Because for me, I want to see my money working for me. I'm working so hard for this money. This money better work for me.
Work for me.
So to me, that's why an education plan a policy was not an option. So because when I looked at the numbers, I was like, so you're telling me I'm going to put this amount of money for 15 years only to give me less than 4% per annum. So if I'm going to put money for that long period of time, let me at least have a better return. That's how my way of thinking.
So it's very important that you mentioned you're a parent. So you're not just giving us opinion. It's actually from experience.
Exactly. So I've put my money in mutual funds. Because I'm like, okay, I can take a bit more risk because my kids are going to go to school. Because right now I'm looking into now tertiary education. So if they're 2 and 3, so I started last year. So that means that they'll be going to school in the next 16 years, approximately 15 to 16 years. So I'm investing on the side. And the reason why I'm also doing it in you can do it in mutual fund, unit trust, is because I also like the flexibility. I'm in business. So what happens when I don't have, the money did not come in as I wanted. So I want to know okay, in as much maybe this month I will not contribute, but my money is still growing. You understand? So yes, I have put my money that specifically in an investment. So you've
put money to educate your children in a mutual fund, which is an investment, and it's making sure it's growing your money. It's also giving you an aspect of flexibility and liquidity in case your business, that of course, what ifs are part of life.
Exactly.
Then how are you protecting your kids?
So now when it comes to the protection, remember I said I'm doing this for the next 16 years. So I've taken out a term life policy to protect.
And what is a term life policy?
So term life insurance is a life cover as well that protects I mean that gives protection for a specific period of time.
Yeah.
So the only difference with maybe an education policy is that there's no payout in the end.
Okay.
It doesn't have a savings element. This is a pure risk product. Remember, insurance was created for risk mitigation.
Yes.
That is the main reason why insurance is there. So in this side, I am investing, but I need to protect that investment, because remember, if I'm investing for these years, if something happens to me in year 5, what is going to happen? So on the side, I have now a term life for that period of time, which is 16 years. So this term life protects against death, disability, or critical illness. So because this is an education plan, how I've structured it is, in the case of a death, that amount of money is going to be put into the mutual fund. So it will continue growing, and it will still take my children to school.
Wow.
You understand?
Yeah.
So that is how I have structured it, because I said, even if, like, you know, she was to hit the fund, the only amount I need to pay is the term life policy.
Yes.
Because because now if it's an education policy, maybe for the exact same amount I'm looking into getting, maybe I have to contribute like about 30,000 per month. Yeah, in an education policy. So if there's a bit of difficulty in my life, it means that now I have to look for 30,000 per month out of my, let's say, my emergency. So rather, instead of that, yes, I've put it now, all this money in a mutual fund or a unit trust, but on the side, I've taken a pure life policy, term life policy, maybe for like 5K a month. So I can handle 5K. You understand?
That's true.
That's how I've structured mine.
So obviously the term life is cheaper than the mutual funds.
Is the cheapest, because most Kenyans are like, oh, why would I buy something which is not giving me money in the end? But remember, even your education policy has a life insurance component. So this one is just that now I have more control. Just as I've given an example earlier with a mortgage. You take a mortgage for 20 years, you have to take out a mortgage protection.
True.
So it's the same principle.
It's the same concept.
The same concept. I'm putting aside money for education, but I have an education protection, which is just the term life insurance. So you can have different life insurance for different things.
See, she has a solution. So if we can go back to my client who was contributing 24,213, how, if then we are not recommending an education policy, then what do you recommend in a way that both of us make sure that the child is educated and the child is protected?
Okay, so just as I mentioned, we split it up. So if you want the best of whichever instrument, it's good to just focus, like, let it do what it's supposed to do. If it's to grow your money, let it just be in an investment. If it's to protect, let just it be in an insurance, because the moment you mix it up, you don't get the best of both. You don't get a very good return, and you don't get a very good protection. So for this one, what we did was we split it into a term, and then the rest of the amount of money, we put it in our money market. So we said we're going to be very conservative in this, but as I said, you can put it in unit trusts or mutual funds like I did. So when it comes to now the protection, for the 5,500 shillings, they are getting now a life cover, in the case of a death, 8.6 million compared to the 3 million that they had. And then in the case of a critical illness, they were, the education policy was giving 1.5, here it will be giving 4.3 million. And then in the case of accidental death or disability, that's another 8. So in the case now someone died from an accident, what this means is they'll be paid the 8.6 million for the life cover and the 8.6 for the accident cover. So that's a whole 16 million, which can be now redirected into the mutual funds or unit trust so that it can grow over a period of time. So remember, this is just education planning. So for this exact same 15 years, so that one, just always look at it as a guard for your money. It's a security guard for your money. And then when it comes to now the growth, we put 18,000 per month, 18,365. So the contribution of the per year goes to 220. And in a good money market for 15 years, eventually someone gets, they'll contribute 3.3 million and get 7 million in return. So you still get a higher return and then you still get a higher protection. So everything is just how you structure it.
Oh my God, that's beautiful though. You said you still get a higher return from your money. Your money still works
money
for
market,
you.
I mean, and it's money market.
If we talk about bonds here, you'd be mind blown about what 24,000 shillings can do for you. So you still protect your child and educate them. And at the same time, in case happen to you, you don't get 3 million. Actually, 3 million. Believe us when we tell you
I know
that 3 million is very little money.
Exactly.
Now, I know we've talked a lot about disadvantages of education insurance policies, but we can talk about 3 other very important key aspects. Is that literally, based on the calculation we've shown you, you're losing money. You're pouring money down the drain.
You are losing money.
Because we say that these policies masquerade as savings and investment products, and literally they are not. And then, of course, we've talked about that the policies are very difficult to read.
Yes.
We said Marianne is here, just go to her. And a very important thing is talk about the flexibility.
Yes. So now regarding the investment aspect, so as I'd mentioned, remember, let's say I'm contributing now like the 18,000. Even if now, as I said, shit was to hit the fan, I've lost my job. The amount of money can still continue growing. You see.
Yeah.
So, and then also, if I get a lump sum, I can pass it there.
Yeah.
So there's that flexibility when it comes to even like contribution of now funds towards the education plan, because the one reason why most people bail out is because sometimes life happens and then life insurance products are not very flexible and you had not planned around it. So even where I am right now, I make sure I have an emergency fund. And then I make sure I have now a life cover which can take care of other things like food, clothes, shelter. Because most Kenyan parents love to think about education, but they don't think when they pass away, there's going to be a huge gap until the time
the kids still need to eat.
They still need to eat.
They still need to buy books.
Exactly, because most of them pay out at maturity. So even if you were to pass away at year 5, this payout will still be done like at year 15. So what happens between year 5 and 15? So you have to have a policy that is going to take care of your kids' needs in between.
Wow.
Yeah. So
that's a big gap.
Yeah, that's a big gap. So I made sure, first of all, I started an emergency fund and a life cover. Then now that's when I got now more funds, I started now planning towards my kids' education. So that's when I said I'm going to now get into now the mutual funds and get a term life just to protect the education aspect. Yeah.
Have you taken us through that one?
Oh, okay. So with this one, it's now we're looking still at Agatha's client.
Yeah.
They're still contributing the exact same amount. So we're looking at the education policies versus our education plan. So still the contribution is 24,213. So the investment return for the education policy after 15 years is 6 million. And for the plan it is that we have is 7 million. Almost a 1 million difference. And then the insurance protection in the case of a death, the education policy would have paid out 3 million and then our plan 8.6 million.
Okay.
So in the case of a critical illness, the education policy is 1.5. This other one is 4.3. Like almost more than that, almost triple.
Almost triple.
Almost triple actually. Also in the case of disability, still there is a payout of, now for the education policy is 3 million and this other one is 8.6 million.
Okay.
So it's definitely much better.
Much better.
More flexible.
Much more flexible, yeah.
But this one, I always say with this sort of plan, you have to be so disciplined because you still have to put aside the money as planned so that you can be able to get to the goal that you expected. So if you're not disciplined and this amount of money you end up eating, obviously you're not going to get 7 million.
Of course. Please note that this money you'll get because you're consistently putting it aside every month. Just that we're offering you the flexibility of if this month you're not able to put in the 24,000, you can always put it next month as a lump sum of 48 or something. Of course, we've already exhausted the money market funds and we've even given you practical example and done the financial calculation, which will display on the screen. But then we have to talk about other alternative approaches to financing your child's education. I always like to remind people that in finance there is a concept called opportunity cost. And opportunity cost is literally the opportunity forgone. So the reason we're having this conversation is telling you, if you sign up to this education insurance policy, you have forgone making triple the amount of money. So always remember that. So of course, at the end of the day, the decision lies on you, but we have to educate you. That's our role here, that there's an opportunity forgone. And so apart from money market funds, there's so many other alternative approaches you can use to educate your kids. For example, Marianne and I know that when you give, for example, this client, when she gives these education insurance policies, the 24,213, one of the ways they invest this money is through treasury bonds, or rather we can call it as fixed income securities. And I always ask people, why do you want a middleman?
When you can do it yourself.
When you can go directly and do it yourself.
And it's cheaper because there's no fees.
There's no fees. I always tell you that when you go to the Central Bank of Kenya and create your own CDS account and invest in treasury bonds, it's free. But you want a middleman. Where we see it's not a good financial decision. It's like literally what we say is that for us when we analyze the different insurance policies, it's literally working hard, giving somebody your money and giving them the job to plan for your child's education. That's literally what you're doing. You're outsourcing your child's education or your child's security to someone who actually doesn't have your best interest at heart. So it's actually your role as a parent or your role as a guardian to choose the best option. So of course, one of the ways, we've already done the math, one of the ways that we advise people to plan for their child education is through money market funds, and because they come with a few advantages. Maybe you can tell us a few advantages you can think of why money market funds versus
So other than the return on investment, there's the flexibility aspect, because to me, oh my god, flexibility is key, because I said most people lose their money because of that. And then also the fact that you can structure it the way it is that you want.
You can customize it for you.
You can always customize it. And then let's say, as I said, today I have 5,000, maybe tomorrow I have a bonus, I can pay out a lump sum. With education policies, you can't do that. You can't just throw a lump sum into the in the policy and then now
that's true.
It has to still be that amount of money, the premium that it is that you expected. So with this one, it's easier now to make like a customized plan with a money market.
So the other benefits, transparency and communication.
There's that. Oh my goodness. I always, even for me, the reason why I also do like mutual funds and unit trust is because of the transparency aspect. I need to know, like, where's my money going? So you're just telling me, okay, yes, you're investing, but okay, how exactly have you split the funds? Where's my money going?
Also, the return on your investment is guaranteed, right? It's not a gamble. And then at the same time, for money market funds, you only need a small amount of money to start. Like even the example we've given you here is this client was contributing 24,000 per month. That's not a small amount of money. But of course, for money market funds, basically money market funds are accessible to any parent, because there are money market funds in this country that allow you to contribute even 100.
That is very true.
Even 100 shillings. And then ease of access, that plays to accessibility or flexibility of your money. And then the cash withdrawal for policy facility is what. And by the way, this is a good time to say that if you want to open a money market fund, any of us can help you set up a money market fund for free. You don't have to hustle. And then of course it beats inflation.
Exactly. There's that part people never look at. You go there because there's actually someone who's telling me that, you go, the amount of money you receive can barely even pay one term.
Oh man. People have had issues in this country. And of course, as we said, that is why you've been calling insurance policies a scam. They are not.
Exactly.
It's that you don't know what you're getting yourself into. Obviously, another option I recommend people to use to plan for their kids' education is treasury bonds. So treasury bonds, in simple terms, is literally loaning money to the government. So the government of Kenya always has a budget at the end of every year, and they always say we need X trillion for this financial year. So you can loan money to your government and they'll pay you interest and also will give you your money back. We're not going to spend a lot of time talking about treasury bonds because this was about education insurance policies, but as always, I'll leave a link in the description box to teach you more about how to invest in treasury bonds and to use them for your child's education. In conclusion, Miriam, what do you conclude? What do you advise the Wealth Tribe?
Okay, so I'd like you, before you even buy any policy or get into any plan, you ask yourself some questions.
A few questions.
It's so important because some of you just buy just for the sake of buying, and then you regret. You have buyer's remorse. There's nothing as painful as buyer's remorse for life insurance because you don't get your money back.
It's not like a pair of shoes.
No, it's not a pair of shoes. You can be like, I hate this shoe.
I hate this shoe and throw it away.
Exactly. This is the amount of money, and especially this is a very important goal. Your kids' education is so critical because you're giving them a chance to be better in life and to thrive. Because I believe even for us, if we didn't have education, we won't be where we are. So first of all, you have to ask yourself, you have to look at your goal. So you ask yourself, are the numbers making sense? So yes, you're being told, okay, I'm contributing this amount of money, then I'm going to make 2 million in 18 years. But you have to ask yourself, if we look into inflation and just overall when it comes to now the cost at that time, do the numbers make sense even as I'm buying this policy? Because also even with the endowment policies, there's levels to it. There's let's just say over 80% of the policies in this country, I cannot touch them with a 10-foot pole.
Where?
Okay. Yes. And then you ask yourself, do I understand the terms and conditions of this policy before diving in? Because many of you get in. This is why now you end up calling us scams, but we're not. So it's very important to now understand what exactly you're getting yourself into. So always read your policy document. And as I said, if you need help, we can help you with that, or you can even ask a lawyer, just someone, rather pay that 8,000, 10,000 shillings, but you know that for sure you've made the right decision from the very beginning. Then you have to ask yourself, do you have a plan in the case you can no longer pay your premiums.
Yeah. Do you have a plan if you lose your job?
If you lose your job, what do you have? Do you have an emergency? Do you have a protection plan? So you have to make sure you have an emergency fund and, you know, like a proper life cover, yeah? And then you have to, that's now ties up with, do you have the fundamentals? Because many of you like focus on education policies, but you don't focus on now like having proper liquidity in the just in case, which is the emergency fund and life cover. Because I said, the education policy, yes, will take care of the children's education, but what will take care of their food, clothes, and shelter? Because the one thing I always believe is, yes, you're taking care of your kids' education, but if they miss the fundamentals, how do you even know they'll go to school?
Yeah.
They might even be bounced from one house to another. As in, you have to now think about that as a parent, and then also you have to look, have you compared different plans across the market?
Yes, don't just buy the one the agent.
The first one. So an agent just comes, they pressure. You just buy because maybe number one, actually most people have bought because of number one, peer pressure, or they could not tell the agent.
Yeah, they could not tell the agent. Oh man,
not even because of like the kids' education. Maybe that one was even So even, and now in conclusion, ask yourself those questions in conclusion. Remember, so we're not education policies, they're neither here nor there. If I was to say now from my own personal perspective, would I get it? Absolutely not. I would not buy it. But again, as I said, to give credit where it's due, there's people who've benefited because because of their lack of discipline, this is an amount of money. At least they had something.
Yes.
At least it was
something. At least they had something. Rather than little money is better than no money.
Exactly. Little money is better than. So it's very important to know yourself. For me, I'm very disciplined with my money because there's no way I can touch my kids' money education. So you go find out your underlying problems, because discipline is something now you can also now deal with. Now Agatha gave all the different ways you can go about it, from automation to accountability. So just know yourself and pick the best plan for you. So when it comes to now education planning, this is also to tell you that there's alternatives. Alternatives which can give you better returns and better protection. So taking care of your kids' education is so important. So just make sure that you do what is best for them and also what is best for you, because you're the one who's doing the contribution. Always do your research.
I think that's a very important aspect where you say do what is best for your children, but also do what is best for you. Because parents, you'll find a parent who is earning 100,000 Kenyan shillings, but they contribute 30,000 of that money towards the child's education. So yes, they are doing what is best for their children, but they're not doing what is best for them.
Exactly.
You have, I believe love comes.
It's true.
You can't kill yourself in the name of taking your kids to
this sort of school.
Schools.
Because again, remember, if you're not doing it based on like what it is that you're comfortable with, it will reach a point you cannot pay.
You'll burn out.
And then you'll burn out, and then you'll lose all the money or most of the money at least.
And you'll now start feeling hatred for people you're not supposed to be hating.
Exactly.
And so for me, I always think that for me, when I think about education policies, again, would I take it? No. And she has made a very beautiful conclusion. For me, I always think of them as going to work every day, working so hard for your money, giving that money to somebody, they charge you fees, and then you, at the same time, allow them to tell you how you're going to educate your children. You're giving them so much power, right? And so in conclusion, in my finance books, that doesn't look like a smart decision. As always, subscribe to this channel, like, comment, and leave all the comments in the section, and also contact Marianne to help you with all your insurance protection needs. Asante sana.
Thank you.